Here are the top 3 tech IPOs right now. These are brand new stocks in tech companies you've never been able to invest in before now. Let's see which ones are worth buying. First up, we have ARM. This is a $55 billion chip making company that's made the chips powering devices like the iPhone, most wearable health trackers, and even the sensors powering smart cities. They went public on September 14th, 2023, and the stock price jumped 25% immediately after the IPO, although since then it's pulled back slightly. Now, when someone says computer chip, you might think of companies like Intel that make the chips that run much of the traditional personal computing world, or even Nvidia, who is just crushing it in the GPU space. But a lot of people don't realize, and I didn't before I started researching this, but ARM is everywhere. This infographic from 2017 shows how the company sold over 100 billion ARM-based chips in different devices with a plan to eventually reach 1 trillion chips sold. For context, that would be 125 chips per person on the entire planet. More recent numbers show that they've already sold over 250 billion chips, with 99% of all smartphones running on ARM-based processors. And yet, weirdly enough, you might not have heard of them if you aren't really into mobile phones or app development, because ARM has traditionally focused on designing small mobile chips that run the ever-growing number of gadgets we all carry around with us. But that's all changing. ARM is no longer the little chip designer providing CPUs for mobile phones and laptops. You've probably noticed that there's new competition in that space, so that's probably a good thing for ARM. But they've now expanded to high-performance chips that can support smart systems in cars, a massively growing market that's only going to continue to grow as cars become more and more of computers on wheels rather than simple internal combustion engine machines. And with an explosion in Internet of Things devices, enterprise chips running in data centers for the cloud, and even new types of chips doing things that we never thought chips would be able to do, like cybersecurity or machine learning. The addressable market for ARM is only getting bigger and bigger. And in a world where chip manufacturing can be prohibitively expensive and manufacturing is often moving overseas, ARM's approach of simply designing the chips and then licensing those designs to other chip makers could be a competitive advantage. And we can see that in their numbers, with the company showing incredibly high operating profit margins of 29%, with an expectation to raise those to 40% in fiscal year 2024 and 60% in the long term, compared to chip makers like Intel, whose margins have historically been around 30%, with them dropping to 12% in their most recent quarter. And ARM even beats out the reigning king of profit, Nvidia. Now, finding ARM's actual earnings has been a little bit difficult since they haven't been reporting consistently before they went public, but they do have a few older reports that we can look at. But even then, direct comparisons can be hard. While Nvidia brought in $13.5 billion in just their most recent quarter, so in 3 months, ARM only brought in a little over $2.5 billion for their entire fiscal year, with $524 million of that as profit. That gives them a pretty hefty price to earnings ratio of 110, which is just incredibly high for a chip maker. Now, Nvidia's ratio is similar, but they're also growing at 170% year over year, and ARM is not matching that. So stepping back from the numbers, what does that mean? Is ARM just too expensive, or are they an up-and-coming company that's going to explode in value over the next few years? Well, it's a little hard to say because it's hard to compare this company to stocks like Nvidia because they don't actually make and sell their own chips. They just license their IP to other chip makers. They're like the Virgin Group of chips. A more similar company is actually Qualcomm, who also licenses chip designs, but they only have a PE ratio of 14, which is way smaller than ARM's 110 PE ratio, although to be fair, Qualcomm is also shrinking while ARM is growing rapidly. So personally, I'm going to wait until ARM announces their first earnings as a public company in around November is what they're saying, before I jump into the stock, because I just don't feel like I have quite enough data to make a decision here. But I do realize that I run the risk of missing out on any rise in price that they see before then. But let's move away from the world of chip makers and B2B companies that only make their money selling to other businesses, and instead focus on a tech company that is making a fortune selling directly to consumers like us, Instacart. And by the way, if you're looking for more stocks to invest in, I have an ebook called Top 5 Stocks I'm Investing in for Wildly Positive Returns, where I break down exactly which stocks I think have the best chance of having very positive positive returns going forward, and I do it using drawings, frameworks, and checklists wherever possible to make it as simple as possible to consume. I've basically condensed down around 10 hours of research per stock into something that you can read in 5 minutes each. And if you want to get one of those stock analyses completely for free, just go ahead and click the link at the top of the description. If you've ever spent a ton of time trying to figure out which stocks to invest in, or you've had people recommending stocks for you, but they don't explain why you should invest, this ebook is going to walk through the 4 major investing trends that are going to be creating outsized value in the market, as well as specific stocks that fit into those trends and are actually outperforming those other stocks both strategically and in their actual earnings. Having this ebook is like sitting down on a call with me and having me explain to you personally why I invest in every stock that I do. And it's written in a way that's fun, super easy to consume, and super actionable, so you can decide within about 5 minutes whether or not you would want to invest in those stocks. And since any one investment could make you thousands of dollars, it seems like a pretty good use of time. So go ahead and check that out at the top of the description, and now let's get into Instacart. So Instacart is interesting. They were originally supposed to go public in 2022, but like many companies, they delayed their IPO amid the economic uncertainties and high interest rates at the time. Eventually, they went public only a few days after ARM on September 18th, 2023, and their stock price immediately surged after the listing, with the stock up nearly 50% from the IPO price at one point. But since then, the price has declined substantially, down 15% from their initial price. So what's going on here? Why is the market struggling to determine the fair value of this company? Well, Instacart is an interesting stock. Really the first of the majorly successful Uber-like businesses, Instacart developed a simple solution for an ever-present problem. You're in a store trying to find that one ingredient when you realize you need to go to another store all the way across town to find it. But you don't have time. You just got off work and you need to start cooking. Enter Instacart, a solution born out of frustration and the need for convenience. Apurva Mehta, a former Amazon employee, saw this everyday problem and thought there has to be a better way. And so Instacart began its journey from a single-man operation to a billion-dollar entity, delivering groceries from local stores to doorsteps across America. But it wasn't all smooth sailing. From lawsuits to unhappy workers, Instacart faced its fair share of hurdles and criticisms.
The lawsuit we brought alleged that Instacart was treating its employees as independent contractors.
The COVID-19 pandemic hit us all hard, but in the midst of the pandemic, companies like Instacart became an essential service, helping people get their essentials without needing to go outside. And thus the momentum for Instacart's IPO picked up steam. So now it's 2023. Instacart is a big food delivery service with competition from the likes of Uber, DoorDash, Getter, and tons of other companies. But what makes them worth $7 billion while most of these other companies are still private? Well, up until their most recent quarter, Instacart had been experiencing explosive growth. Just look at these numbers. Net income up 704% year over year. Revenue growing 50% year over year. A few quarters later, net income up over 1,000% in a year. Those were some crazy numbers, even if the company had a high price to earnings ratio of over 60, more than 3 times the market average. But many stock analysts aren't convinced. This article talks about how analysts at Goldman Sachs and other banks that helped Instacart go public expect the company's growth to stagnate or even drop over the next few quarters. And with rising delivery costs and increased competition in the space, some question if Instacart's grocery delivery model can even sustain profitability in the long term. But there is hope. First of all, analyst forecasts are usually worth less than the pixels they're written on, especially if they're issued by a company that would just love to buy up more shares for cheap after driving down the stock price. Secondly, Instacart is expanding into the advertising space, using their position as an intermediary between shoppers and stores to act like a yellow book for groceries. That's a dated reference, but the point is they have strategic options open to them, and those options have the potential for making way more money than their existing grocery business, if they can execute. I personally think Instacart is going to be a very binary bet. Either they'll succeed in grabbing grocery store market share from both the physical delivery side as well as the digital tech side, or they'll fizzle out like a lot of peer-to-peer companies have. I personally just don't see them puttering along at their current price for too long. Which leads us to our third and final tech IPO, and the one that I personally was the most excited to learn about. Klaviyo. Now, I would guess not too many people have heard of Klaviyo when compared to something like Instacart, but they're actually a bigger company overall. Klaviyo went public at a price of $30 a share, and they rose moderately in price the day after, up 9%, with the company currently trading at a total market cap of $8.2 billion. So what exactly do they do? Well, have you ever been considering buying something and then suddenly you get an email with a coupon for the exact item that you were thinking about? Or have you ever walked by a store and your phone gave you a notification from that store? Both of those situations very likely could have been powered by Klaviyo. Klaviyo is a marketing automation company that focuses on email, SMS, mobile push notifications, and reviews, and specifically on how companies can use customer data to make more money from their customers using those platforms. Cross-channel marketing is one of the few areas of digital marketing in general that's not just completely dominated by Google or Meta or the other large players. Rather than running ads on websites or mobile apps, Klaviyo focuses on getting customers that you've already interacted with before to just buy more of your products or services. Now, they have all the usual stuff: AI-powered analytics, dashboards businesses can use to predict customer behavior, and their customers include some pretty heavy hitters like Unilever, who owns brands like Vaseline, Axe, and Ben & Jerry's. And Klaviyo also works with other brands like Kim Kardashian's Skims and Citizen. But while digital marketing is a very fast-growing space with tons of room for Klaviyo to launch their new products and expand their existing customer base, is the company actually worth $8 billion? Or for the stock price to go up, could it be worth even more than that? Well, Klaviyo reported revenue growth of over 56% in their most recent quarter, bringing in $585 million in revenue. They have a pretty high dollar-based net retention rate of 119%, meaning that for every $1 a customer spends this year, they can expect that same customer to spend $1.19 next year. Then just layer on top of that the fact that the company now has over 1,400 customers spending over $50,000 annually on the platform. And that helps remove one of the biggest criticisms of Klaviyo, that they're too dependent on Shopify to drive revenue. And even though the company is not yet profitable and they are losing a small amount of cash each year, their incredible growth rate could still make them attractive at their current price, with a price to sales ratio of under 4. Now, we can't calculate a price to earnings ratio for them because they don't actually have any positive earnings. But for comparison on the price to sales ratio, The Trade Desk is another digital marketing company who trades at a price to sales ratio of 24 currently, which is 6 times what Klaviyo is seeing. So if Klaviyo is able to grow long enough that they can use the efficiencies of scale to become profitable, this could become a money-making machine in the future. So based on these numbers, I personally bought a small position in Klaviyo. They don't have enough of a track record as a public company, and I don't like that they're burning cash, but with a little bit of inflow of funds that they've received from going public, I think they have a decent chance of becoming profitable in the long term and even reaching 5 to 10 times their current size. I'm obviously not willing to bet all my money on that, but once they've reported a few more quarters, I'll probably increase my investment or sell out of all my shares depending on what they show. But let me know if you think there's another IPO that's worth looking into, and let me know if you've invested in any of these stocks that we talked about. Just let me know in the comments, and I'll see you next time.